Dan, thanks so much for being on Wall Street Week. First of all, let's get your sense of how turbulent the time is. Are we headed to a recession or not?
We do think we're headed towards recession at this point, yes.
And how bad, how long?
Well, recessions are, of course, very feared events. One of the interesting things about the stock market is it's been a great predictor of recessions, and typically stocks peak 8 to 10 months ahead of a recession. Stocks peaked at the end of December, early January this year. So although NIBR hasn't officially declared a recession, the stock market is saying we're probably in recession now as we speak.
So, Dan, one of the things that we've seen a lot of in the moving of funds, as well as people talking about it, is as we go into these turbulent times, people are saying that's the time you want to go into value. You don't want to be in growth. And in fact, if you look at some of the big funds, they've lost a fair amount. The growth funds have lost a fair amount. What does history tell us about when you go into recession, where you want to be?
Yeah, so that's a really important point. I mean, history, there are patterns that you can invest in, even in turbulent times, even through recessions. Very important to understand that because essentially it's about having a game plan, during economic volatility and recession. And what the history tells us actually is that as we enter into a recession, growth stocks, in other words, companies with strong business models, low debt, operating margins that are higher than average, they tend to do better than, say, highly leveraged companies with lots of operating leverage, in other words, a fixed cost structure, and of course, companies that weren't growing particularly well before, that only tend to grow with economic growth. And so what we have seen in the past, historically, is that as we enter into recessions, value companies, value stocks, tend to have significant earnings compression, declines in earnings, while growth stocks actually tend to hold up fairly well. Now, the other part of history that's important to note is the first stage of a market correction is really valuation compression. And we've seen that across the board. And it is also classically true that growth stocks compress more than value stocks. But I think we would actually see a lot of signs that part of this market cycle is already over. The next part is really about the economic recession and the decline in earnings that it will bring across the market. And that's where actually growth stocks start to shine.
So Dan, I think it's important in what you said there. It's not all the companies that are considered growth companies. You have a subset that you really focus on.
Yeah, I mean, it's really interesting. Alger's philosophy is focused on fundamentally the disruptors and the innovators across industries, as well as a category we call life cycle change, which are sort of companies that may have experienced tough times that we think are about to experience better times because of innovation or management and leadership. We have some interesting history from top growers. In particular, if you look at the top 75 companies across the largest 750, so the top 10% of growers, their valuation actually has compressed so much that relative to the market now, they're actually at multi-decade lows. And that, again, that gives us some confirmation that it's really probably time to start thinking about not so much the start of the recession, which, as I said, probably has started already, but what it looks like coming out of recession and into recession. And that's where, again, these kind of growth stock leaders, the valuations have compressed, the fundamentals are likely to hold up better than average, and certainly better than value cyclicals. And we think it's, a good time for long-term investors to think about the opportunities there.
So Dan, let's go a little more specifically if we could, because we want to try to help investors make some good investment decisions here. What specifically would you be looking at right now in those growth companies you described?
Sure. So I think one thing you look for is what are the strongest trends in business and in society in the world, and then of course the companies that are leading that, right? The disruptors, the ones that are taking market share. Digital transformation of business is sort of where machine learning, big data, cloud computing all come together, right? This is all about making businesses more efficient in their cost structure, efficient in how they manage their employees, getting more productivity, and of course, efficient in reaching and servicing their clients. And so, when you think about the center of that, that's really software. That's what's driving it. And then, of course, the powering of that is semiconductors and hardware. But think about companies, we think like companies like Viva, which focuses on the healthcare industry and making everything from clinical trials to product recalls more efficient. vast amounts of data that help improve clinical trials results to target medicine, but also lots of data to make sure that if there is a recall, they know exactly why there's a problem and how to recall it and who has it. It's companies that are also, for example, of course, transforming every business by moving to the cloud and helping them do that. So every business uses a lot of software. Companies like Datadog, they do application performance monitoring on the cloud. That means, if you have 100 applications running across your company, that may be payroll, that may be marketing, that may be customer service, and that of course may be your manufacturing or core service capabilities. All those applications, you need to monitor them for their performance, the downtime, the accuracy. And Datadog, for example, is a company that provides software that helps you do that, basically manage your digital infrastructure. So data transformation is incredibly important because particularly in a recession or in difficult times, the most important thing businesses want to do is get more efficiency out of more limited resources, right? Maximize their efficiency.
So Dan, when you talk about life cycle changes, it strikes me that one of the places we're seeing a huge change right now is in energy. As we go toward renewables and we also try to get more efficient in our fossil fuels, what sorts of opportunities do you see there, if any?
Oh, that's absolutely correct, David. I mean, we have liked the renewable sectors, solar, wind, EVs, battery technologies that are going to power electric cars, as well as backup power for a long time. But given the Ukrainian-Russian war, the effect on oil, natural gas, and other prices, the traditional energy industry, which had been in a bear market, is now poised for a transformation, what we call life cycle change, a growth renaissance. And the reasons are very clear. America is, fortunately, now a world-leading energy producer across many fields, not just renewables, but the traditional oil and gas. And liquid natural gas, for example, we're a leading producer. Companies in the U.S. are important not only in producing natural gas, but for example, the processes and logistics to ship natural gas in the liquid form across the globe. So we're very excited about the opportunities in that area as well as the renewables area.
One more that applies perhaps to all the growth companies. In general, I think growth companies is, if you look at the life cycle of their earnings, more of them are out in the out years. As interest rates go up, that means there's a steeper discount back to present value. Does that warn you away from some growth companies because the interest rates look like they're going to keep going up for a while?
So that's absolutely correct. It's what we've seen already, I think, the valuation correction for the fastest growers, because yes, the opportunity for growth stocks is what they do 3, 5, 10 years from now in terms of revenues, earnings, and cash flow. But as interest rates go up, those cash flows, those future opportunities get discounted, and investors, of course, become very fearful and tend to focus on the near term. But by many measures, in particular, in the large cap sector, the valuation compression has already gotten to the point where large cap growth stocks are actually relatively cheaper than they have been in decades against the market. And so, we think it's an opportunity to start, picking the best of those growth stocks for, of course, the inevitable market recovery.